Hello, everybody. In Module 1, I provide introduction to theory, discuss traditional models of capital markets, and explore how disclosure affects various capital market outcomes. The module has 6 lessons. Today, we're focused on Lesson 4, how disclosure affects various capital market outcomes in perfect competition models. Last class, we discussed the Grossman-Stiglitz model, which is a model of perfect competition. However, there is no disclosure in that model, so we cannot address how disclosure quality affects various capital market outcomes. This is what we're going to do in this lesson. We incorporate public disclosure into a Grossman-Stiglitz model and see how various capital market outcomes vary with disclosure quality. The implications, in particular, the comparative statics, form the backbone of empirical studies on how disclosure quality affect the capital market. The discussion is based on Goss and Young 2017 Annual Review of Financial Economics. If you want to know more details, go check that paper. Now let's look at the model. There are 2 assets. There's one risky asset with uncertain payoff and noisy supply. And there's a risk-free asset. The risk-free return is normalized to 1. There's a continuum of traders with Kara utility, and a proportion is privately informed. Each of them observes a private signal that is informative about V. Disclosure is modeled as a public signal Y, which equals V plus eta. Eta is normally distributed noise with mean 0 and precision tau eta. Tau eta is the key variable in this lesson because tau eta is a measure of disclosure quality. Higher tau eta is, the better the disclosure quality. One example of disclosure is earnings disclosure. How to solve the model? If you know how to solve Grossman-Stiglitz, you know how to solve this because the process is essentially the same. The only difference is now there is a new public information, Y. So when calculating conditional expectations and conditional variances, Y has to be incorporated. Still, we conjecture a linear price function. Price is a linear function of public disclosure Y. It's a linear function of the average of private signals V and the linear function of supply X. In Grossman-Stiglitz, they have a term on prior mean. In this case, we don't because the prior mean is 0. So any numbers times 0 is 0. The coefficients Py, Pv, and Px are going to be determined endogenously. Once again, P is a noisy signal about V, and after a suitable transformation, P is informationally equivalent to V plus the noise. So price informativeness in this case is the precision of the noise, or rho squared tau x. Again, as in Grossman-Stiglitz, the demand of each trader can be written as expectation of V conditional on their information set minus P divided by risk aversion coefficient gamma times the variance of V conditional on their information. Relative to Grossman and Stiglitz, here each trader has one more piece of information Y, which means that the Bayesian updating becomes more complicated, but calculation of the conditional expectations and variances still follow the same Bayesian updating procedure. And you get the demand for informed trader and uninformed trader. And then market clearing condition, the aggregate demand equals supply. That results in a linear function P. And matching coefficients would solve for the equilibrium, Py, Pv, and Px. Those are the solutions. This can be done using Mathematica. And once we have the equilibrium, the focus is going to be on comparative statics implications for how disclosure quality affect the various capital market variables. Let's first look at price informativeness, which is defined as the precision of V conditional on P. Conditional on observing price. How much do you know about V? Price informativeness is increasing in tau eta. And this is intuitive because price reflects the information of every source, including public disclosure and private information. With more precise public disclosure, price informativeness is going to increase. In the extreme case, when public disclosure reveals V perfectly, price is going to be equal to V, and price informativeness is going to be infinity. Now let's look at illiquidity, which is captured by the absolute value of Px, because Px is a negative number, price decrease with supply. Strictly speaking, Grossman-Stiglitz model is not a perfect model to address illiquidity, because everybody takes price as given. But conceptually, the larger the absolute value of Px is, the more illiquid the stock is. That's just because conditional given noisy trading volume, price moves more. The illiquidity is decreasing in disclosure quality, which means that more precise public disclosure increases liquidity. The reason is twofold. The reason is more precise public disclosure makes price more informative of V. So price is going to respond less strongly to noisy traders' order flow. In the extreme case, when public disclosure reviews V perfectly, price equals V and would not respond to noisy traders' order flow. The second reason is that more precise disclosure reduces the information asymmetry between the informed and uninformed, making the uninformed more willing to trade. So in this case, price is going to respond more to informed and uninformed traders' order flow and less to noise traders' order flow. Now let's look at earnings response coefficients, which is PY, the coefficient on Y, if we interpret Y as an earnings disclosure. Of course, the larger PY is, the larger earnings response coefficient is. We can see here that more precise public disclosure results in larger PY, results in larger earnings response coefficient. The intuition is quite straightforward. With more informative public disclosure, earnings are going to be more informative, and price is going to respond more to more informative earnings signals. Now let's look at exposed return volatility, which is the volatility measured in a period after earnings announcement or after disclosure. We can see that this volatility is decreasing in disclosure quality. And intuition is that more precise disclosure moves price closer to V and thus decreases volatility. In the extreme case, when public disclosure perfectly reviews V, price equals V and the variance becomes zero. Now let's look at cost of capital. Cost of capital is defined as expectation of V minus P. You can think of a cost of capital as some investors, they purchase the firm after the disclosure. They purchase at a price P, and they withhold the firm until the terminal payoff is realized, and they get V. So their cost of capital is how much they get, V, minus how much they pay P in expectation. Perhaps counterintuitively, in this model, the expectation of V minus P is zero, which means that public disclosure quality does not affect the cost of capital. Why is that? This is because the noise supply, X, has a mean of zero. If you assume any positive mean, then more precise public disclosure is going to decrease cost of capital, and vice versa. Why is that? If you have a mean zero supply, that means on average, investors hold zero supplies of the shares. It means that on average, they don't bear any risk of holding the shares and having to discover what V really is. So in this case, on average, cost of capital is equal to expected terminal payoff. On the other hand, if you have a positive average supply, that means investors on average hold a positive numbers of shares, which means that they bear a positive risk of holding the shares. So because they're risk averse, there is a risk of premium for holding the shares, which means P has to be smaller than V to account for that risk premium. With more precise public disclosure, P is going to move closer to V, which means that cost of capital is going to decrease. So far, the proportion of informed traders mu is exogenously given. However, if you assume that information acquisition is costly, then this mu would be endogenously determined by the public disclosure quality. And Ghost and Young, they basically shows that more precise public disclosure is going to crowd out private information acquisition, which means mu is going to decrease in public disclosure quality. And this turns out to be a quite robust result. And the reason is very straightforward. With more precise public disclosure quality, informed trader is going to get less trading profits. And because information acquisition is costly, there will be less informed traders to acquire information. So mu is going to decrease. Well, this implies that some of the capital market consequences of more public disclosure may be different if we endogenize mu. For example, price informativeness could go down if there is less private information acquisition, because while price reflects more precise public information, it reflects less precise private information. And price could be moving away from V because of less private information. However, liquidity would increase even when we endogenize mu. And the reason is, if there is less information acquisition, there is less informed traders. The information asymmetry is going to be smaller. So this further increases liquidity. However, other than liquidity, every other capital market consequence result could be overturned, as shown in Gosen-Yang. So to summarize, more precise earnings disclosure in general has beneficial capital market effects. It results in higher price informativeness, it results in higher liquidity if the number of informed investors is going to be fixed. However, if we assume that the number of investors that choose to be informed is endogenous, then more precise disclosure can crowd out their private information acquisition activities. And then the capital market outcomes in general is ambiguous, other than liquidity. Liquidity always improves with more precise public disclosure. So that's the end of this lesson. In the next lesson, we're going to talk about price formation in imperfect competitive models, the Kyle model. If you want to test your understanding of this lesson, a review quiz of this lesson can be found here. Thank you very much.